Hey all, welcome back to ShareTreck, and today we got a very special and intriguing video concept for the ShareTreck friendos out there. We're going to talk about different investing styles, and what better way to start off than asking Mr. Raj, Mr. ShareTreck, what is your investing style? What did you got to share with the ShareTreck community?
Yeah, Sandeep, thanks. I thought that this is a very interesting discussion to have. I mean, when you suggested we could have this chat, because retail investors are of different types. There are some who are young college students who have just started their jobs and they are interested in investing. Then there are others who are, specialists in their field. I mean, there are scientists, there are doctors who are excellent in their field, but when it comes to finances, they don't have an idea of much of the things that are happening. So they are also retail investors to a good extent. So I'm looking at all the retail investors and I'm thinking, what advice would I give any retail investor? So I'll draw upon my own experience because I'm a retail investor and I started off many years ago and I made lots of mistakes, made some money and lost lots of money too in the process, not to be too modest. So I think that as far as retail investors are concerned, the question that they have to ask themselves is, if I'm going to invest, do I have the time, energy, and the knowledge and resources to follow the company that I have invested in so that I can see how well the company is doing, what its market is like, what position does it hold in that market with regard to its competitors, what are its competitors doing, what edge does this company that I have invested in have over its competitors, can it maintain its edge, and how good is the operations? Am I looking at the balance sheet on a regular basis every quarter to see whether the cost is being controlled properly? Is there any kind of splurging happening? So all those questions are to be, kept track of in order to make a successful investment. And I think if a retail investor feels they don't have the time, energy, resource, or capability to do those things, then it's better for them not to invest in stocks as a direct category. They can still get exposure to stocks, but they could invest it, say, either in the mutual fund or exchange traded fund area. So when it comes to mutual funds, one of the problems with mutual funds is that the fund manager is always under pressure to redeem. So if there is any weakness in the performance, there will be a lot of fund holders who would want to sell the units, and the mutual fund manager is forced to sell portfolio elements, even if it's at a loss, in order to pay back those that are asking for the money. So that is one drawback with mutual fund. The other drawback with mutual fund is that it has got high MER, or management expense ratio. In order to avoid these problems, one could turn their attention to ETF, exchange traded funds. Exchange traded funds are just like mutual funds, but instead of a mutual fund holder redeeming and forcing the portfolio manager to liquidate assets, what happens is that the shareholder of the ETF sells at a lower price to somebody else, and that's how it is compensated. Whereas the corpus of the ETF remains focused on the composition that it launched with and the objective that it was looking at, without being interrupted by the panic reactions or exuberance of the unit holders. Best example is ARCG. If ARCG was a mutual fund, I think Kathy Woods would be broke by now. All the shares would have been sold at a loss, and the fund would no longer exist. But because ARCG was structured as ETF, despite people panicking, the corpus of ARCG remained intact, and Kathy Woods was still able to make all her investment decisions, however scary they might be to the layperson. And all that happened was people who didn't have confidence, they sold their units at a lower price, and people who believed in it bought it up at a lower price, believing that they are dollar cost averaging. And the guys who sold think that they are getting out of a bad deal. So who is going to be right? We'll find out in the long run. But ETFs generally have analysts behind it, and they have a fixed strategy. They have portfolio allocation, risk management, all of that well defined and announced in advance, so that you know what you are getting into. So I would say that for a average retail investor, before they jump into stocks, they should look at ETFs, and that's one of my first advice. The second advice would be that you could have beginner's luck. You may end up buying a share, and you see the share price going up, and you say, "Oh, it's gone up. Maybe it'll go up even further." So you put a little more money and you wait to see it go up a little more. It goes up a little more, and then you say, yeah, I'm going to hold on for a longer time and I'll get more profits. But then the share starts falling. So when it falls a little bit, you think it's just a temporary fall. It's going to revert back, and I'll book the profits where it was before it started falling. And then it falls a little more. And then you think that, you know what? I should have taken the profit when it was at the peak. I've lost the opportunity, but it's going to turn up and go back again. So in this process, you'll soon find that the share price has gone below your purchase price, and now you're raking up losses, and you don't want to sell with a loss. So you vow to yourself that next time I have a profit on this, I'm going to take it. And if you stick to your promise, you may probably take the profit as soon as it is even 1% or 0.5% above your purchase price, and you would have kept the money for almost a year and earned 0.5% or something like that. And if you are not the person of your word, then you're going to allow it to go further up. So you'll be on the roller coaster of the share. You would go through 2 or 3 cycles of ups and downs, where a professional trader would have taken profits, bought it at a low, taken profits, sold calls, and so on. You have done none of those things because you are a newbie retail investor. All of us go through this. There is no shame in that. But what I want you to recognize is that when you see profits, when your profit target is achieved, book it. Don't worry about what you're going to lose. Get the profit, keep it aside, and do whatever you need to do with your principal. So that's the second piece of advice that I would like to give you. Third piece of advice: do not ask anybody, what stock should I buy? Or should I buy this stock at this price? Because the person who is going to give you an answer, they have a mindset in which they are looking at risk, they are looking at opportunity based on their mindset and their risk tolerance levels. What they think as less risky might be super risky for you, and what they think as optimistic might be super optimistic for you. You never know. And the second reason why you should not ask anybody for this kind of information, even for that matter, should I sell the stock now at this price? Those are all wrong questions. Those answers should come from within yourself, because when you enter into a trade for a particular stock or ETF, you should have a target profit at which point you're going to exit from there. So you should already have that. And you should also have a stop loss kind of a thing, like at what point of loss you're going to bail out. And you should never ask third party for that. Because whenever you ask advice from a third person, when they give you a answer that you should buy so and so stock at so and so price, they have a set of variables that they are looking at, and they have read up on various things, and they have a state of mind which allows them to give you that price. But that state of mind will quickly change because they are continuing to do more research, read more articles, look at more news items, geopolitical catalysts, and all. And you just took a 1 point snapshot from them. You went ahead and invested, you forgot about it. After 3 months, you come to them and say, what should I do with this stock? It is languishing. And I bought it at such and such price. Then they will turn around and say, you should have sold it within 15 days, because within 15 days, they went into a merger with another company and bought down the stock price. And you don't know about it, right? So basically, it's not a spectator sport. Buying stocks, buying ETFs, or investing in the market is a active sport where you have to be actively involved. But as I said, you can do ETFs. And Sandeep, I think that you have insights into ETFs. Can you tell
Yes.
our audience what precautions they should take when they go for ETFs and
Yes.
why?
Actually, before we jump into that, you just reminded me of something I read years ago, and a little bit of a story where back when we had that big momentum rally for companies like GameStop in, I think it was 2021, there was a lot of negativity towards the retail investor and the Reddit investor and so on, saying you're buying all these companies that don't have great fundamentals. And I remember once Kathy Wood, she came out and said from ARK, ARK Invest, she said that she sees this as a positive because it's bringing in people into the market, young people, and having them be interested in this. Some of them might have lost money, some of them might have gained money, but some of them might have became investors. And I thought that was just so poignant.
Yeah.
Such a great point that Wood, Miss Kathy Wood brought out. And another interesting story about when you were saying that some people just follow whatever's going on. I remember once I went to the bank and met with a teller, and the teller said something to the regard of, I noticed you have a investing account. What do you think of this stock? And I got a little giddy, a little excited because I thought this man works at a bank. He also was talking about investment. So I started talking about like the earnings and the margins of this company and something in the recent statements. I quickly realized this person had no idea what I was talking about. So I had to tone back a little bit. But referring to part of me for if I got a little off tangent.
No, no, no worries. Yeah.
Um, so talking about ETFs, we like to talk about the difference between a passive investor and an active investor. Active investors, they do a lot of the research, they think about when to exit and enter positions. Passive investors, where you put your money in a company and put it money in an ETF or a company, and you just kind of wait. And what better way or kind of exemplifies this as the S&P 500 ETF? I like to think of the SPY, the SPY ETF, as the one where a lot of people follow. It has a large market cap, a lot of interest. Um, the S&P 500 analysts from Standard and Poor's, they pick the 500 companies. And if some companies have bad earnings, bad statements, those companies get dropped and new ones enter. We have companies entering in and out all the time. Just recently, SMCI got added into the S&P 500 and another company exited. If we were to take a look at some of these, it brings up the conversation of sectors. And this right here is a place called Finviz. You can just Google Finviz heat map and find this. This is all the sectors, and the larger the square or rectangle, the larger the percentage of weight the S&P 500 that company might have. So if you take a look at something like semiconductors, you'll see NVIDIA having a very high chunk of that, and then companies like Broadcom and AMD, and other areas like healthcare. You see Eli Lilly, a very big chunk as compared to something like Gilead over here. This analysts take out companies that add companies all the time. So this is kind of a very nice way to get some US diversification in all the sectors. But what are the sectors? I like to follow this thing called the Spider Sector Selector, and this is the entire S&P 500. You'll see in the last day it only went up 0.12%, but other sectors like energy, uh, there's a ETF for that, specifically for that, XLE. It went up 1.5%, and you could find all the great weights of that sector and other things like materials, things like where is technology? Technology, which is the biggest aspect of it. You'll see the top holdings, top movers for that area. And year to date, what did some of these sectors do? We'll see real estate didn't do as well, but as a whole, S&P 500 actually did not too badly. So it's something that a lot of investors could consider just putting your money in something like this, and you'll get some diversification in all the areas. But if you want to go specifically in an area, there's ETF for that as well. And there are other ETFs. There is the NASDAQ 100, which a lot of that is tech centered, but that could be a discussion for a different time. I like to think of the S&P 500 because it's got a little bit of everything. It's a lot of people's favorite ETFs too, but we could even go even more specialized, Raj, where this kind of brings up a discussion we were having earlier, where it's a trend I saw that there's a little bit of overrepresentation in the gains and the performance of the S&P 500. And this right here is the SPY. It's a ETF. It's a passive investment ETF for the S&P 500. And you can see the year-to-date gain was only about 11.74%. There's also another ETF, another passive investment called the RSP, Equal Weight SP 500. As we saw over here, there's different weights of these. Some of these have higher weights, which I've got a company called Slick Charts. You can see that Microsoft makes up 7% of the entire S&P 500, where some other company like Netflix makes up less than 0.6%. This one right here, RSP, it has an equal weight to all 500 components, but the year-to-date performance has been less than 7%, which kind of tells me that some companies are overperforming other companies in the S&P 500. And what better way to see this than this ETF called the MAGS MAG 7 ETF? It just got the top holdings of the S&P 500. And if you were to see the year-to-date return, it's nearly 22%, whereas the S&P 500 has had less than 12. Kind of tells me that the big companies in the S&P 500 are kind of outperforming. But that also comes on a little bit of risk where if these 7 companies were to underperform, then you could see a higher than expected loss as well. So there's risk to everything. Risk in sector specific, top 7 company specific. So nice balanced way is just S&P 500. But what do you think, Raj?
Yeah, I think I like the way you presented this whole thing. S&P 500 SPY ETF and those two ETFs which are on the either side of S&P
Yes.
500 in terms of performance, basically because of how they have weighted the components. Now, I would like to say one more thing, which is basically what Warren Buffett does: buy, hold, and prosper.
Mm.
So what I would say is that if you look at any any of our index, all the index ultimately are going up. Periodically, they may dip, but they go up. So if ultimately they are going up and you are a retail investor and you are young and you have a long horizon, the only intelligent thing you need to do is to pick the right sector and the right company, preferably if it pays a dividend and if it is a progressive management. And then you just invest and you forget about it. Don't look at your portfolio on a daily basis. If you look at it after 5 years, you'll definitely find a nice growth. And then after 10 years, it will be even more because the index keeps on going up. However, I'll caution you with an example of my own mistake. I invested in a company called Yellow Pages. Young people won't know what Yellow Pages is, but before internet, we used to have a thick yellow book in which all the company's name, address, and phone number used to be there, arranged according to the business that they were in. And the idea was that this book will come free to everybody like a telephone directory. And if people wanted something, they'll go through the Yellow Pages, call the business, and the business gets some new customers. So
Nice.
that was the idea. And Yellow Pages was paying a steady dividend.
Mm.
And the internet had not yet started. So I had Yellow Pages. It was one of the heavy dividend payers. Well, I was very happy. My mistake was that I didn't keep track of the technology and I didn't recognize the fact that internet will be a big risk factor for Yellow Pages because the Google search and other things became more dynamic, and the whole business plan of making a business model of having a thick book printed every year and sent across to residents, that became cumbersome because most of the people are now looking at Google,
Mm.
and all those companies started advertising in Google instead of on Yellow Pages. So the investment in Yellow Pages just got wiped out,
Oh.
and dividends also stopped. And yeah, they are now struggling to become more relevant in the internet space. But
Huh.
once they were a huge dividend stalwart, they are not now. So that is the caution I would say, that make sure if you're going to do the buy, hold, and prosper thing, put it in a future-proof company
Mm.
and revisit it every once in a while. If you see that that particular sector or that company is getting a bit weak, no harm in selling it and moving into something else which is more future proof. So
Yes.
that's one thing I would like to add, Sandeep.
Yeah. Hey, great addition. I
Yeah.
wonder if would you happen to know if Yellow Page is still around today?
I see the Yellow Pages building when I drive across the 401. I think I see the building out there, but I don't know if they are in there. But I think they are trying to do some kind of internet marketing.
Oh,
That's what they are working on.
intriguing.
So that's a story for another day. But
Yeah.
yeah, so overall for retail investors, I think the message, Sandeep, from both of us is that
Yes.
if you're not going to be an active investor, if you don't have the capability to, or the time to, or the resource to individually monitor the companies that you invest in, then it's better for you to go the ETF route.
Hmm.
And also, you have to preferably invest, if you're going to do direct investment in companies, invest in companies whose products you use or whose products you know. Don't
Yeah.
put it into something that you don't know. There will be a lot of exotic companies coming in promising exotic products and exotic
Yes.
returns. But nothing has been proved. So you have to be very careful about that. Know the company that you're investing in, know the products that they produce. So that's what I would say. And Sandeep, thanks for the exposure to the ETF field and about the sector weightages.
Yeah.
We'll do more of these
Thank
videos
you.
in future. And in the interest of time, I think we'll have to wind down our discussion today, Sandeep. Thank you
Perfect.
so much.
Thank you, Raj. And if you like what you see here today, let us know in the comments below. Hit a like, subscribe, and let us know what you want to see in the next video. Thank you very, very much.
Thanks a lot, guys. Thank you, Sandeep.